No, it looks like it's recording. Yeah.
Perfect. It's recording. Awesome.
Yep.
So thank you so much. Let's jump right in. I think what we will start with. I can get my slides to move. 1 second. Oh, sorry. You guys can see my screen, right? Okay.
Yes, you can. Yeah.
I think let's start with introductions. Firstly, thank you, Aaron, so much for doing this again with us today because we messed up the recording last time. So really appreciate it. Maybe you can start with your introduction and.
Sure. My name is Aaron Hafner. I'm a home mortgage consultant with Priority Home Lending. I've been in the mortgage business and helping people find homes for about over the last 20 years. So it's I work in the Seattle area market and pretty knowledgeable with the area and all the surroundings around it. So thank you for letting me be here. Perfect.
And I'll briefly just introduce myself, Shilpa Sehgal, MD Value Ventures, and I am a licensed real estate professional. And I believe that I've worked in the corporate field for about 18 years, and now I've jumped into this because I want to help fellow corporate immigrants like myself to make smart investment decisions in real estate. So that's briefly about me. Let's jump into and talk about what is it that we're going to cover today. So today is going to be about Mortgage 101 for first-time home buyers. We will talk about mortgage basics, then jump into the process and the nuances of getting a mortgage, and then a little bit about the home buying process, right? So what does it take to actually buy a home from end to end, from finding a home to doing the deal and actually getting the keys to your house? We'll then touch upon certain mortgage myths and tricks because there are a lot of myths in the market. We'll debunk some of those myths there. And as time permits, we'll get into some trends and forecasts. So where are the mortgage rates going? What's going to happen next, right? So we'll try and look through the glass and forecast what's going to happen. So that's essentially what we will do. If you have any questions, feel free to add them on chat here and we'll answer them as we go. I'd request everybody to be on mute because towards the end, we will open out for questions and interactions as well. So let's jump right in. So Aaron, can you tell us a little bit about the basics on mortgage, right? So what are the types of mortgages available out there?
Yeah, there's several. I mean, this is kind of like we have our mortgage menu, if you will, right? There's several different products for different loan types. And typically, the conventional bucket is going to be the one that's going to be the most common. And those are just, you can do as little as 3% down mortgages. Those are basically bought by the government, Freddie and Fannie. But those are the most popular selection because they typically have the lowest rates sometimes, and they're just overall that's what most people fit into. The FHA loan is basically it's buyer friendly, meaning that if your credit score is not perfect, or there's some other more relaxed underwriting guidelines. Underwriting guidelines means the qualifications for the mortgage might be a little bit easier, but and have more flexibility for credit. So if the credit is not perfect, then this loan program might fit for them. It is a government-based loan, so it's backed by the government. And they have different kinds of mortgage insurance and stuff like that that's included in there. And we'll go over that in more detail. But the credit scores don't have to be as high as it would be on a conventional type of mortgage. The VA loan is meant for the military, people in the military. They have special benefits that they can use to purchase a home. One of the biggest ones being is that they don't have to have a down payment. So those loans are backed by the Veterans Administration, the VA, and those maybe are good options for people in the military or married to military members. The USDA is basically where you're going to be. It is income based. So depending on where you live, or you're purchasing a home, the requirements there might have a low to moderate, or it's meant for income. So it's based upon income. If you qualify for this type of mortgage, it's more in the rural area, and you don't have to have a down payment. So those are kind of nice options if the home is located in a USDA requirement or in a rural kind of area. And then the next one, yeah.
So essentially, I think people who are looking at buying in cities would either have the conventional loan or the FHA loan. Both have
Correct.
certain advantages and disadvantages. The VA loan is
Mhm.
great, but you have to be in the military. And only if you want to go buy in a rural area that the USDA loan would be applicable.
Yeah, it would be. Yes. So I would say most of the people are going to be looking at conventional and the FHA for sure.
Perfect. And let's talk a little bit about jumbo loans now. I know
Mhm.
that's the thing a lot of people in markets like Seattle or New York tend to need, essentially.
Well, yeah, the conforming loan. So the government says a loan is conforming means it conforms to the government guidelines, and the government guidelines have a loan amount depending on where you live to a certain loan amount. So anything above that loan amount, the government won't sponsor. So therefore, it would be like a jumbo type of loan, and the jumbo type of loan just has higher loan balances and higher allows you to go higher loan balances. But you also the requirements of getting a jumbo loan are a little bit harder. So the underwriting or the qualifying guidelines are harder. Not that you can't do it. It's just that it's just a little more extra qualifications that you need to have. So, but in this Seattle market, a lot of people, first-time home buyers, can do jumbo loan programs and that kind of thing. So, so yeah, that's kind of how it is. So just more underwriting on those, and some people can qualify and some people can't. Maybe you go to a conventional, then go to the jumbo in your next home. But yeah, and then outside the box, we have the non-qualified mortgages, which means that these are just out of the box type of scenarios, meaning you're self-employed. You don't make as much money, so your debt to income ratio has to be higher, and that kind of thing. And so, and those have higher interest rates and that kind of stuff. But most of the times, you're going to be in the jumbo category or the conventional category, depending on the loan limits of where you're living.
Got it. So essentially, say a jumbo loan in Cleveland means something different from a jumbo loan in Seattle, given the
Yeah,
market.
I mean, ultimately, yeah. So the way that it works, so across the country, the conforming loan limit is around 766,000 across the country, right? So anything above that would be considered a jumbo loan. But in King County, King, Pierce, and Snohomish counties, that limit goes up to 977,000.
Wow.
So you could do a conventional loan up to 977,000 and have the easy underwriting requirements for a conforming loan. If the loan balance goes above 977, then you'll go into the jumbo category where the underwriting guidelines might be a little more strict. Not that you can't do it. There's just an extra layer of underwriting or qualifications that you need to have for those loans.
So some advantage of living in an expensive market, huh?
Exactly.
Awesome.
But we can. So there might be some jumbo investors that will allow us to go down to 766,000, and we just underwrite it with the tighter guidelines. So we will find the best. Most mortgage people will find the best rate and value for you when we look at those.
Perfect. So I think we get a sense of the types of loans available. But now credit scores is super important when it comes to getting a mortgage, right? So can you share a little bit about how can I build a credit score, or what can people do to?
Yeah, this is a great slide, okay? Because it's interesting because a lot of people don't understand, or it's kind of confusing. What do I need to do, or how's my credit score impacted? It's like a very esoteric kind of score, right? And people don't understand what it is. So basically what it is that when you look at your credit score, 35% of it is your payment history. How long have you had something? Have you paid it on time? And that kind of thing. And then the other one is how much do you owe? So depending on, you've paid it in the history, but how much have you actually owe on the debt that you have? And mind you, this is debt. So it's not your cell phone bill, insurance payment, or anything else. This is money that you owe to somebody else. So if you think about a utility, they can shut it off if you don't pay. But if you have a car loan, they're going to take that car back if you don't make the payment because you've borrowed that money. And so basically it's 30% of how much you owe, and then the link to the credit history, right? So how long have you had that history? And then you can see the other two, just 20%, is basically new credit accounts. When did you open that up, and that kind of thing, and types of credit that you've had. Is it like a credit card, a car loan, a mortgage, whatever? But the biggest things that you'll see is the 15, the 30, and the 35% make a huge chunk of how your credit score is derived. And so I think when people ask questions, it's like, hey, if I pull my credit, is that going to impact my credit score? Yeah, it will for a teeny bit, but it's not going to impact as much as how long you've had a credit card, how much you owe, and how have you paid in the past. So I think those are the biggest things with establishing credit. That's what takes a little bit of time to get those things started. So typically you'll see on the right-hand side, it'll say 740 to 850. Those are good credit scores. Anything above a 740 is going to be good. And then if you go between the 680 and the 740, that's okay. And then 620 to 680 is okay too. You can qualify with all these different types of credit scores. It just impacts what kind of loan program you have and the interest rate that you'll receive. So again, if starting out, the best thing is to either get a car payment, you get a credit card and start paying that, and that'll establish your credit.
Perfect. Essentially, so it looks like the history and the duration that you have credit is extremely important. So if you're planning to buy a house, say 1 year down the line, and you're new to the country, start planning now. Get your credit cards. I know conventionally it said, oh, it's better not to have debt, but that's not the case when it comes to building your credit score. Right? So,
yeah, I mean, that's correct. The thing is that the other thing you want to look at is if you do get a credit card, right? So in this, I've seen this a lot. So you get a credit card and they only give you $1,000 credit card, right? But you go to Costco, you go somewhere else, and you can put $500 on that credit card pretty easily. And part of it is how much balance that you have, how much you owe, that 30%. So if you go above more than 50% of what your credit limit is, that will impact your credit score. So the thing is that, and sometimes there's a 30-day delay by the time you pay something to the time the credit bureaus actually pick it up. So if you think you're going to be applying for a mortgage, let's talk beforehand and just make sure if you do have something like that, let's pay everything down, make sure the credit score looks great. So then when we pull credit, you'll have the best possible score.
Perfect. So essentially, I think you're almost saying open multiple credit cards so you don't max out your credit card. Because
correct.
Awesome. So I think this is interesting. We do understand a little bit about credit now. But I think the next question that always comes up is that how do you determine what is your affordability of buying a house? Okay, you've built this great credit score, you've got all of that going. And I think one of the ways to figure out what your affordability is that how much down payment do you want to make? Right? And where is this money coming from? Do you have money sitting in your stocks? Is it in your savings account? Are you going to get a gift from somebody there? Right? And then the other key factor to look at is what's your monthly outflow and what are you comfortable with? And I think, Aaron, you do have the debt to income ratio. Maybe you can cover that a little bit.
Yep. Yeah. So basically, I mean, you have your limit of what you think you can qualify for, and the lending guidelines have what they think you should qualify for. Okay. So there's like a regulator on top of that. But ultimately, in most of the scenarios, your maximum debt load the maximum that you can owe with the new mortgage payment and your current debts really can't be more than, say, 50% of your gross monthly income. So it's basically, they cap it out at 50% as maximum debt load that you can have. So that includes your mortgage plus any other debts that you have.
Perfect. So while that's what the lender will approve you for, I would suggest don't go more than 30% towards your housing cost, because then that's the smart, and because you want to diversify your risk and you want to diversify your portfolio. But the other key thing to look at is what is it that you're currently paying for rent? Because when you're paying rent, you're essentially paying somebody else's mortgage, right? So does it make sense for you to take the money that you're paying for rent and pay it towards your own mortgage? When you look at your total outflow or your monthly outflow when it comes on the mortgage, there is a principal component, there is interest, then of course there's taxes, insurance, and if it's a condo, there's HOA. But when you look at your rent, you should look at your rent component equivalent to the interest. And one thing interesting to note is that over time, your interest is going to go down. When I say interest is going to go down, what I mean is the interest payments are going to go down. Your total monthly outflow stays the same. However, over time, if you continue to rent, chances are your rent is going to go up. So whenever you're doing your calculations on the rent versus buy decision, do keep these factors in mind. Aaron, do you want to add something about the amortization here?
No, I mean, yeah. I mean, ultimately, when you lock into say a 30-year fixed rate, you're guaranteed what your payments are going to be. If you're renting, that can go up, and it'll most likely go up. So if interest rates are lower and you lock in at a lower rate for the 30-year duration, you know what you're going to be paying. You're not stuck. You know what I mean? You're not going to have that variability of what the lender or of what a landlord's going to charge you for your rent. But the answer to your question, yeah, the interest, As you pay more principal on your loan through monthly payments or extra to principal, the interest that you pay for the life of the loan will go down.
Perfect. So I think we've now covered a little bit about affordability and budgets. And now let's jump into the actual mortgage process. How do we go about getting a mortgage?
Yeah, I mean, the first thing is you start off and you start off with the application. You talk to a lender and then you fill out an application, and they will go ahead and pull your credit. And essentially, for the underwriting, for the process of it, they're all going to look at your credit, income, and assets. We call it CIA in the business. So credit, income, and assets are going to be looked at and reviewed. So that's the application part. Then once you have the application, we'll switch everything over to our processing team. And the processing team will go ahead and put the file together, go over any documents that we need to obtain, and then they will package it up to send it to the underwriter. The underwriter is the person that will approve and validate the credit and income and assets that you provided. Once the underwriter reviews and approves everything, and we get the appraisal back on the home, we verify the home value matches to what the loan amount would be, then we send everything to our closing department. And our closing department will put everything together and print out the loan documents and send them to the escrow company. In Washington, we use a third-party company that will go ahead and have you sign the loan documents. They will make sure the money gets transferred to the seller in terms of their funds when they sell the house. The home gets transferred into your name and that kind of thing. So that's pretty much the process. So you go from application to processing, underwriting the file to make sure everything's approved. Once everything's approved, the loan documents go out to the escrow company, and then you sign the documents and you're ready to go.
And typically, Aaron, how much time does this process take?
It depends. I mean, most of them, the standard typical will say, like, can you close in 30 days? Right. And the more, I mean, every lender has different time paths and everything else, but for where we're at, we can crunch everything down as little as a week and a half to 2 weeks.
And I think that's the advantage of working with smaller local vendors like Priority, because big banks, underwriting takes time and appraisals take time. So
they're just bigger. We're smart, fast, and local. And I think part of it is working with a true mortgage professional that knows the market, knows timelines, knows, things need to move quickly. And when you find and identify a home that you like, that home is yours, right? And so we want to make sure that you have an awesome experience. Buying a house should be fun and not stressful or anything else. And getting this process and working with the right true professional can really move things along, get you prepared way ahead of time. So when you do find that property, we can close quickly to compete and be super competitive in this market.
Perfect. So now if we are at a stage where we've decided that, yes, we want to go ahead and start this application. I know there is, even before you start an application, there's pre-approvals and there's pre-qualifications. Can you help us to understand the difference between the two?
Sure. So the pre-approval, I think that's the next slide. There we go. Yeah. So there's two things. So again, when you do the pre-qualification or pre-approval, you're going to talk to a mortgage professional, and they're going to say, hey, I want to validate your credit, income, and assets and pull your credit and put everything together. And sometimes people will say, yeah, I want to do that, but I don't want you to pull my credit because my credit score is going to go low. And from that previous slide, you could see that when we pull the credit, it's not going to really impact your credit that much. But the difference between the pre-qualification and pre-approval is that I'm not really pulling credit on a pre-qualification. And basically, you're just kind of giving me the information. You're just saying, hey, look, here's my credit, here's my income, and here's my assets. And I look at it and go, yeah, this should be able to work for what we're trying to do. And that's a pre-qualification. Nothing's been verified. And when you do the pre-approval means that, hey, I went ahead and I've pulled your credit. I've looked at your credit and income and assets all in full, in detail, and all the documents that go with that. So it's just an extra layer of qualification than it would be on the pre-qualification. So pre-qualification is just kind of look at it and go, yeah, this looks like it makes sense. Where the pre-approval is like, yes, we've gone through and looked at everything. It does fit the guidelines. And the computer systems are pre-approving your loan. So that's a much stronger letter than the pre-qualification letter.
Perfect. So to be clear, so it's better to have a pre-approval than a pre-qualification.
Correct, because you want your offer to stand out with the seller, right? So if you're putting offers all together, if there's a multiple offer situation you're presenting to the seller, you'd want to have a pre-approval for sure. That's just part of the starting part in this market that we have. You have to have a pre-approval letter. No one's going to look at the pre-qualification letter because it won't be as strong.
Perfect. So now let's jump in and talk about what are the documents that are needed. How do I prepare for applying for a mortgage?
Mm-hmm. Again, we talked about the credit, income, and assets. So that's what this slide talks about. So basically, you just need pay stubs, W-2s, W-2s, tax returns, that kind of thing. It also kind of depends on what your income is. If you're self-employed, might have a couple different pieces of income or documents than would be if you're just a salary. But basically, we all probably need the pay stubs, W-2s. We need to check your income too, and then we validate your employment. So basically, you just need to make sure you've been in your employer and we talk to them and make sure that you're working there. Then we need your driver's license and or ID or whatever it is, social security card maybe. And then we just verify your assets. So basically, it's 2 months of bank statements is typically what we need to verify assets.
Perfect. I think this explains that a bit. And let's jump into understanding the detail. We did cover this briefly.
Well,
yeah,
depending on. So remember, I talked about your amount. So again, the debt to income ratio is kind of the hard stop. If you go past one of these ratios, the loan won't be approvable. So basically, what we're looking at is it's your debt to income ratio. So it's your recurring monthly debt, car payments, student loans, that kind of thing, not utilities, plus the new mortgage payment. So that includes your mortgage payment will be your taxes, insurance, mortgage insurance, all that stuff. So your total debt plus the new mortgage payment divided by your income, your gross monthly income. So if you look at what your gross is, not after taxes. So as long as that ratio typically is under 50%, for most loans, you'll be okay. If your credit score is not perfect, I won't say perfect, but the credit score is like in the 600 range, maybe the computer system will not approve you up to a 50% debt to income ratio. It might stop you at, say, 43%. And the same thing for an upper level jumbo loan. So if you're doing these higher loan balances, they typically have a lower debt to income ratio for their requirements. So sometimes you will be stuck at 43% versus 50%. But typically on a conventional loan, you'll probably be able to go to 50% debt to income ratio.
Perfect. So based on your income, they will figure out how much debt they can give you. So
correct. And that's part of the analysis. So that if you're self-employed, we just have to figure out what the income is. And because your debts are pretty easy to find out. It's just calculating the income. If you're a salaried employee, that's pretty simple. But if you're self-employed, you have multiple incomes from different places and stuff like that, that's where it becomes a little more challenging. But that's how we look at it. It's all based about your debt to income ratio.
So I think interesting, you also brought up mortgage insurance. Mm-hmm. There was a question here around how much down payment is needed. Yep. But when it comes to mortgage insurance, if you have a 20% down payment, then you don't need mortgage insurance. Is that correct?
Correct. The premise with mortgage insurance is it protects the lender.
Right.
So in case if the loan falls in default, the lender is compensated by an insurance pool, if you will. So just think about like your car payment or a car, right? You pay car insurance. If there's damage or the car is totaled, that insurance pool that you've paid in each month will pay off your car loan or pay off the car. And the same thing with mortgages. So if you have less than 20% down, there's some form of mortgage insurance you would pay to protect the lender because you have less than 20% down. And a lot of these programs, mortgage insurance can be removed altogether without together. It's not for the life of the loan. FHA does have mortgage insurance for the life of the loan, but yeah, that's kind of basically what it is. It just protects the lender. So if you do 5% down, the insurance premium that you'd pay each month is higher than would be if you did 10% down or 15. So 20% is the magic number. Without mortgage, you don't have any mortgage insurance unless there's 20%, unless you have 80% equity in the house.
Perfect. But essentially, you can do a down payment as low as about 3.5%. What's the lowest?
You can do as little as 3%.
3%. Okay. So.
Yeah. And there's programs out there that you can help with down payment assistance and stuff like that. But ultimately, yes, 3% is kind of what the minimum you need on a conventional loan, conforming loan. Sorry.
Right. Awesome. So now from here, let's figure out, we figured how much, loan we can get, but now let's talk about what is it that we should not do once we are in the process of.
Sure. Well, one is you probably don't want to quit your job. That's probably a good one not to do, right? So again, we're going to verify employment all the way to the end of the loan process. So, yeah, if you're switching jobs, we can still kind of make it work, but if you can avoid it, don't, but if you're going to get like double your salary, then go double your salary and you can figure it afterward. But ultimately, you don't want to buy new appliances or put new debt together or anything like that, because that debt to income ratio is so important. So the thing is that we will check at the end to make sure you haven't hasn't been additional debt. And if there has been additional debt, we have to add that into that debt to income ratio. So again, a lot of people find out when they purchase home, they're super excited. They want to go out and buy appliances or these certain things, and those could possibly impact your approval, the approval of the loan. So once you're under contract, freeze. Don't do anything. I know you want to, but that's the biggest thing. So that's the biggest thing I see is people being new accounts and that kind of thing before the process is over.
Perfect. And actually, that brings me to the question around, there's a question here about co-signing, right? So if there is somebody who can co-sign the loan with you who has a better credit score, can you explain what would happen then, and would we get a better?
Yeah, so anybody on the loan that we have, right? You can have the primary borrower and then you have your co-borrower, the co-signer, right? And the way that it works is they'll combine all the credit, or they combine your income in your assets and all your debts. And we do that debt to income ratio with everybody who's going to be on the loan. The one thing we do not combine is the credit score. So everybody who qualifies has to clear the credit hurdle. They have to qualify. So if someone has, let's say, a 600 credit score and the co-signers have an 800 credit score, you would have to qualify using the interest rate and mortgage insurance to be determined by the lowest credit score. So the higher credit scores don't lift up the lower credit score. You all have to clear the hurdle for qualifying on that loan. So they don't say someone who's 800 is it'll magically make it better. If you have 600, then your interest rate and the pricing of the loan will be determined on the 600 credit score.
But if you have co-signers that have a higher income, your debt to income ratio would be better. And
we combine the income and the assets and the debts and put it all together. As long as you standard that, whatever the debt to income ratio threshold is, you'll be okay. So what co-borrower or co-signers really help with is helping with income and qualifying. It won't help so much with someone who has a lower credit score.
Okay.
Right. So we see that a lot. Hey, look, I really want to buy this house, but I don't have enough income. My parents will help me buy the house. We will all be on the loan together, and I can use their income to help qualify for that debt to income ratio.
Right. Okay. Awesome. So the lowest credit score stands, a higher income stands, right?
Yep.
So that's
so you would have a little higher interest rate because your credit score is lower, but you can qualify, right? So So and then what we would do is we try to figure out how we can improve the credit score, right? To make that work. But that's a great question, because a lot of people think that if I have a co-signer or co-borrower, it'll help me, with the credit, and it does in certain sense. It helps you qualify, but not so much for qualifying for the rate. Yeah.
Perfect. So then that brings me to the next question about interest rate, right? So there's APR and there's interest rate. So can you explain the difference between the two? And
yeah, it's the APR basically is it's a quick way that you can look between different lenders to see what fees they're charging and that kind of thing. So your interest rate is the rate that you'll be charged, your payment will be calculated on. So if the interest rate is, say, 7%, then that's what your payment will be calculated on. The APR is the cost of the loan in general. They figure out what the cost of the loan is in a percentage. So someone might say, you might see an advertisement that says interest rates are 3%. And you go, wow, that's really good. But the APR might be 15%, which means that there's a ton of fees built into the loan that create that 15, so it makes you question. Typically on a traditional mortgage, a 30-year fixed kind of deal, if the interest rate is, say, 7%, the APR might be like 7.2. right? So it just kind of rolls into different costs. So there's different ways that you can pay additional fees to get a lower rate. And the APR puts that into, allows you to look at that quickly to kind of do a quick judgment between the different lenders. So when you do get their breakdown of costs and fees, you will see the one that has the higher APR will typically have more fees than the one that has a lower APR. So you want to, if you're looking at seeing if there's additional cost, the closer you are to the actual interest rate, if the interest rate 7% and the APR is like 7.3, and there's another one that says it's 7.9, then you would assume that the fees in the 7.9 will be higher than the 7.3.
Got it. So essentially, when you're shopping for mortgage, APR is what you need to look at.
Well, you can. I mean, like I said, what you really want to see is the actual breakdown of fees with that lender. So if someone's if giving you a really good rate, you'd want to see the breakdown of costs and fees to make sure what's actually there. Okay.
Perfect. And I think then that brings us to the next question about how does somebody say that, oh, you're going to get a 3% loan when the rest of it is, say, 7%?
Yeah. And so what you're basically, the great question I ask is that, so when people ask what interest rates are, what you're really asking for, what's the cost of the rate today without additional fees, right? So what happens is if you're trying to buy a house, or you're looking at these interest rates, you can, if the interest rate is, say, today at no cost, okay, there's no additional fees for the 7.25%. That's the first line on that column, the first row. And there's no additional fees, right? So it's 7.25. But if you want to pay a little bit more money and get a lower rate, you can. So you can buy it, you can get it at 7%, but it might cost you 1% of the loan amount in order to get that rate. Okay. So in other words, if you want 7%, you would have to pay an extra $6,650 to get your payment to 4,424, which is this $112 savings. And you can do the same thing too. You can say, I want 6.75 and I'm willing to pay the 2% to get a lower rate. Okay. And so that's kind of how buying the points or paying points down, that's how that works. And so then what we do is we look at it, does it make sense to pay the points? The points is a one-time fee that you pay to get the lower rate. And so if I look at the break even, that's one of the things that we look at. So is it worth it to pay an extra $6,650 in the second line and to save $112? And that's kind of what we look at. The break even is basically 5 years. Am I going to keep this mortgage for more than 5 years? Then yeah, it makes sense. But if I'm going to keep it less than 5 years, then maybe it doesn't. So that's why there's a lot that goes into deciding whether to pay points or not. And that's why working with a good mortgage consultant can really help you out. Because everyone looks at that 6.25 and says, I want that one.
Right.
Right? But then we're going to figure out, does the math really work out? And the thing is, if you extrapolate it all the way down, so you can get 2% today if you really wanted to, but it might cost you 20% of the loan amount in order to do it. But if you do the math, it actually works out. You're better off paying all those points for the long term of the loan. The challenge is that life happens, right? Maybe you get a great job and you have to move, you have to sell the house, whatever. Once you pay that one-time fee, it's gone. You know, and so again, when we're in rate environments that we are right now, where we're seeing them where they've been the highest they've been in, you know, quite some time, we all anticipate interest rates will go down. And so if we start to pay points and say you pay the 6.75% and you're paying an extra $13,000, and literally maybe a year from now, interest rates go from 6.75 down to 5.75, you'll want to refinance that loan into a lower rate, but then you've already paid those fees all up front. You know what I mean? So we look at that and try to figure out what's the sweet spot that makes sense.
Absolutely. So in this example, between 7 to 6.7, it just does not make sense to take the 6.7 because both have a break even of 5 years.
Yeah, I mean, but we look at, but see, these point structures change on an hourly or daily basis based upon the mortgage, based upon the stock market and the market and the bond market and everything else. All lenders, when we get our money, because what we're doing is we're loaning that money to you. So we've got to get money to pay the seller. You know, when you buy a house, we got to take that money and we're going to send it to the seller, and you're going to pay us back. And so every lender has to get their money from somewhere, and there's costs associated with that, right? So it costs our company money to obtain this mortgage, right? To lend this money out. And so every company, like anything else, is going to have their profit margins and everything else and say, look, here's what we're at today at that, say 7% or at the 7.25%. But if you want to get that lower rate at 6.25%, it's going to cost our company money to obtain that money at that 6.25%. So we're going to pass that additional fee on to you. Okay, so that's how they look at it.
Perfect. So my key takeaway is do your maths, do your Excel models. Don't jump in and say, "Oh, I want a 6% loan," right? So
a good mortgage consultant will help you with that. They will walk you through it, because to me, mortgage consultants aren't paid or there's no benefit to anybody other than if you take a lower rate or not, or the additional fees that you pay. The government has wiped all that out. Okay. So the only way we just look at it is see what makes sense for you and based upon your goals and what you're looking for.
Perfect. So I think now that brings us to the next question. Okay, we've figured out the APRs, we've got a good interest rate, and now we are at how much cash do we need to close? And can you put some light on that?
Yeah. So when you have your cash to close, the funds you have to bring into the closing table, right? You're like, hey, this is what we need. It's going to be the total cost of the loan. So when you purchase a home and you get a loan, there's costs that you're going to have to pay to put the loan together, and there's third parties that we used in conjunction to put your loan together. So you have the closing costs of the loan plus the prepaids of taxes and insurance. So when you purchase a home, your taxes and insurance will be included in that monthly payment, and we will pay them typically on your behalf. Okay. So we have to make sure there's enough in that bucket, if you will, to pay the taxes and insurance when they are due. So you kind of prepay everything up front a little bit. So you have your closing costs, your prepaid items, and then any additional points or anything like that you decided to pay. And then what we do is we subtract out any credits that you might get from the seller. So if the seller is willing to give you some money towards your closing costs, we will subtract that out, as well as the earnest money. So if you put earnest money down, that's a credit towards your loan, or for the total funds to close. And that's how you get your cash to close. So it's your total cost of the loan minus any credits that you're getting from the seller or any earnest money that you put down.
Perfect. And that's something that you negotiate with the seller. Hey, the seller needs to pay this. But let's double click on the costs that are associated with it, right? So who charges these costs, right? Where does this money go? What are the different buckets?
Sure. And that's part of getting your loan estimate, right? On your loan estimate, when I say get the fees and how they break it down, that's what you'll get from every lender. And so basically what it is that your closing costs, so let's just break down. So what fees are included in your closing costs? Well, have an appraiser go out and look at the house. That's a fee. The appraiser is going to charge a fee to go out there. We're going to pull your credit, any points that you want to pay to get that lower rate if you want to do that. I talked about an escrow company where they're going to go, that third-party company that helps us sign the loan documents and transfer the home into your name. They charge a fee based upon your loan amount and the sales price. And then there's like lender fees. Any lender is going to charge a fee for putting a loan together, which is your processing, underwriting, all these additional fees that need to go in. And then you got recording fees with the county. And you also have title insurance too. So you have to make sure that the easiest way to explain is that when you purchase a house, there can be no other liens on the property. The only lien on the property has to be the new mortgage. So if you buy a house and someone comes knocking on your door a month later saying, hey, you owe me $50,000, you're going to say, well, I just bought the house. Well, I had a lien on the property. And when the home is sold, I get my $50,000 and I didn't get my $50,000. So it's an insurance policy. If that happens, that makes sure you're protected. It's a one-time fee that you pay at closing. So that's required on all loans. So those are the kind of different fees that are in there, and those are typically all the costs. So now we can negotiate who can pay some of those costs too. And one of them is either, you could have the seller pay it, that kind of thing. I could try to pay it for it if you want to, but by paying for it, you have a higher interest rate. So we talked about points, how you pay a fee to get a lower rate. You can get credit from a lender if you take a higher rate. So you look at the break even on that and see if that makes sense. But basically, typically, it's mostly negotiated from the seller if you can do it.
Perfect. So basically, key takeaway here is there are a bunch of closing costs. Some of them are percentages of the house that you buy. A lot of them are fixed fee costs as well.
Yep.
Right? And all of this can be negotiated. So you negotiate this with the lender, with the seller to figure out what's the best deal that you can create. And your realtor helps you in a lot of these things, right? So what's important for the seller? How do you negotiate this? So I think that's all about creating this deal so that it works for both parties, for all parties essentially.
Yeah.
Awesome. So I think that explains it well. Let's just briefly cover what is the overall home buying journey. Now you've decided that you want to go buy a home. What's the first thing that you need to do? I would say first thing is start looking online, right? A lot of people do that. Look online, go for open houses, figure out what are the kind of things that you like. Find a realtor that you trust, somebody who understands your journey, what is it that you're looking for, and can help you to make these decisions, right? So home buying process, it's one of the biggest purchases that you would make. So a realtor is not only your negotiator, but they also very often help you to clarify what is it that you're looking for and why. And then once you do have that clarity, work with a mortgage lender to understand what is your affordability, right? So what is it that you get your approvals, get your pre-approvals, get your pre-qualifications, and then start bidding. And when you bid for a house, there's a lot of work that goes in there. You do pre-inspections potentially, or you negotiate with the client, you do your due diligence, and there are a whole bunch of inspections that you can look into, maybe a sewer inspection, or so the HOA documents need to be understood. So do your due diligence, put in your offer, and then you would reach a stage of what's called mutual acceptance. And you feel, oh my God, I've got the house. But the process is just half done there. There is a lot more that goes on after that. Because once you do get mutual acceptance, you need to go in and put your earnest money. So earnest money is essentially the money you put on the table saying that, hey, I am serious about this deal. And if I decide to just walk off, I'm ready to let that money go, right? So that makes your offer stronger. Obviously, you don't lose that money because then you put contingencies there. So you figure out what contingencies you've put. And then once you do the additional inspections, you go back and negotiate with the sellers potentially. And of course, in parallel, the loan company or the mortgage company is doing their appraisals. The loan is getting approved. You're scheduling your movers and everything. And then on the final day, you pay your closing costs and your down payment. And that's what happens on closing day, and you do your final signatures. And that's when you are officially the owner of that house. So that's the home buying process, very briefly. Happy to take any questions that are there. Just put them in chat here. So now from here, anything you want to add on this, Aaron? Did I miss anything in the home buying process?
No, I mean, I think, there's a lot. Buying a house should be fun. Okay. That's the first part of it. It should be fun and exciting. You're creating a new chapter in your life. You are, this is where you're going to raise your family or whatever it is. Right. So the thing is, it should be fun, and you want to work with someone who's fun and giving you knowledge and then you make the best decision on that. So I think working with someone who's going to look out for your best interest is the best way to do that. And, the process will begin. I mean, it is a process, but it can go pretty quickly. So, but I just, you find a home that you like and you work with the true professionals, and they can guide you through that process. And so this process, because like it might be quite long, but it's really not. All this can be done in a couple weeks, but being prepared ahead of time and working with a knowledgeable real estate professional is a big deal. That would totally make it worth it.
Yeah, and if it has to happen, like within 3 days, the house that we are currently staying in, we saw it in the market, and within 3 days it was ours, right? So it can move quickly. But I know people that have been at it for years, and they keep losing bids on houses. So that's where you need to work with a professional to figure out negotiation strategies or be ready for the house when it comes on market. So
correct. Yes. The more knowledge you have and the more confidence you have in making a decision, the faster you can make that decision. You know what I mean? So I think having everything done, doing your work up front, and just being ready to go will make the process so much easier, because we'll be working with a place of confidence, knowing that, hey, I've done my due diligence. I'm working with true professionals that are guiding me through this, and that's the best way to go.
So now let's jump into some of the myths that are out there about mortgages.
Mm-hmm.
And I know there's a myth about the 20% down payment. So
yeah, that was the first question that we on there, right? So It's funny, if you look at some of the stats, myth one, do you need 20% down? No, I mean, it's cheaper if you do, but it's hard to say that's a lot of money, right? So 6% of first-time home buyers, the median down payment for first-time home buyers is around 6%. So and you can qualify for 6% for sure. And then repeat buyers are around 17%, and all home buyers is around 13% for the down payment. So I know there's that goal of trying to reach the 20% to obviously make the payment a little bit lower and reduce the mortgage insurance. But if you're in an area where the home values are continuing to rise, it's harder to say, you know what I mean? It's harder to save up if the home values are going up 5 to 10% a year. So, so yeah, if you can get in, the best part is if you can get in, you can gain your equity and your home will appreciate. Just get in.
And also the PMI, don't get too worried about the mortgage insurance, because the minute you hit 20%, that drops off. So
yeah, there's certain strategies that we can look at to mitigate that. Okay. So there's a couple of days that we can look at it, but ultimately you might have to pay the mortgage insurance for a little bit. And if we do refinance the loan, meaning you refinance the loan into a lower rate loan for the current rates, and the home values have gone up, then we might be able to get rid of the mortgage insurance and reduce your monthly mortgage insurance or monthly payment and save you. I mean, when rates were dropping back in during the pandemic, I had people that had mortgage insurance that were paying a couple of dollars a month, but we moved their interest rate from whatever it was and down to 3% or something, and we saved them $600-700 a month. I mean, and so that's the thing. When you work through true professionals, they will guide you through this and walk you through it and stay in contact. It's not a one-time shot. But if you can get in, that's what you need to do to get in. So.
And let's talk about credit scores now.
Mm-hmm. So again, I found this very interesting. This just talks about you don't need perfect credit. We talked about that before, but all the baby boomers, people born in the basically 40s and mid 50s, have a 742 credit score. Generation Xers around 706, millennials around 687, and the Gen Z is around 679. I think a lot of it is because of history and how long you've had credit impacts that credit score. So if you're a Gen Zer, you would think that they probably don't have a long history of credit. Again, it just kind of depends on what you have. But ultimately, if you have some credit, if you pay your debts on time and you don't overextend, your credit score will be fine, right? So, but then again, I understand life happens, right? So something does happen and whatever. You can always fix your credit score. Your credit score is not something just etched in stone. There's ways to fix it, and it's more like erosion as opposed to something that you can just change right away. So if you do have a credit event that needs to be fixed, rip off the Band-Aid and start fixing it, right? And you can do it. I've had a really good friend of mine had a 650 credit score, and now she's over 800. It just takes time, but again, there's ways that you can get into homes with having a lower credit score. We get a lower credit score, you get your credit score improved, interest rates drop, redo the loan, and you're saving a lot of money. So.
Perfect. So essentially my takeaway here was that, while it's good to have a 20% down payment and it's great to have a 740 credit score, don't let that deter you from buying your home. It need not be a dream home. It need not be a forever home, but get into the market, because home prices on an average in US have been increasing at least 5% year on year. Yes, there are ups and downs, but when you do go buy that home, plan to hold on to it for about 5 to 7 years at least. You don't have to live in it. You can rent it out, and you will most likely make money on that investment if you plan to hold it for the long term.
Yep.
Right? So,
one more thing to add on that too. So if you have an owner-occupied property, is going to have a lower interest rate than would be if it's a second home or investment property. But if you purchased a home as owner-occupied and then you decide to move and rent it out, that interest rate won't change. You're still stuck at the owner-occupied rate, which is great.
Right. Oh, that's another good point for sure.
Mm-hmm.
And I know people are very worried about, oh my God, the interest rates are high now. What if I buy this and I get locked in for and next year the interest rates go down? Will I have to pay some refinancing fees? And what is that like? And I know you have this.
Yeah, so we have a program here at Priority Home Lending right now. It's called a Refinance in 5 program, a Refi in 5. So if we do a loan for you and interest rates drop within the next 5 years, we'll cover your closing costs for the new refinance. So that includes our processing and underwriting fee plus the appraisal cost, right? So the appraiser is the person that's going to go out there and make sure the home value supports the mortgage. So we'll cover those costs for you. That's probably around, I would say maybe $2,500, something like that. We'd pay for it. So, and most of the time when you can do a refinance, you don't have to really pay the money out of pocket. You can roll some of the costs into the loan itself, so you don't see anything out of pocket, as well as it'll lower your monthly payments. So but that's one of the things that's great right now, because we all know interest rates are at a higher rate, and the Fed, has told us the direction that they want based upon inflation, right? So the Fed has said, look, if the inflation numbers are getting better, mortgage rates will come down. We will lower interest rates.
Yeah.
And so we know that. So the idea is, I don't want you to wait until rates go lower. Get in now where it's not as competitive somewhat, right, depending on rates. And then we can refinance your loan in the next 5 years. You might get lucky enough to get the seller to pay some of your closing costs. Then we'll refinance the loan for you at no cost. And then you're gaining equity in your home rather than waiting.
Perfect. And I think that brings us to the next question about trends, right? Where is this going? Are the interest rates going to go up, go down? What's going on here? So
this one is a great slide. This is what you were talking about, Shilpa, about betting against the champ. So this just shows what interest rates or the appreciation from home ownership or from appreciation from homes year by year since 1942. Okay. And you'll see that the red numbers are years where the equity went down. Okay. And you can guess the equity went down in 2007, 8, 9, and 10. That makes sense. The Great Recession for everything. Okay. But you can see, if you go down to 2021, down the second one at the very bottom, you can see it jumped up 19% during COVID, right? And all these years they've gone up. And look at after 19%, you're like, wow, it's not going to go up that much higher. In 2022, went up 6%, right? So the idea is like the appreciation in a home, I don't think it's not going to just kind of keep doing this. I think what you're going to see, it's almost like a tier. You'll be here, and all of a sudden something happens, and then boom, you'll be up here. And then boom, you'll be up here. So I think the idea is, I think you're most likely going to get equity in your house and appreciation than if you're not. And that's what this chart shows.
Perfect. So yeah, don't get too bogged down about the high interest rates, because look at the bigger picture. Historically, home prices have gone up, and it kind of nets it out. But yes, I know we're worried about interest rates. So let's talk about that a little bit, right?
Shilpa, let me just show you this. So you can see the history of interest rates, and you see where it says 1983 or 1981, how high it was, or 1981, how high it was. That's like 15% with the interest rate. Yeah. Can you go back to the previous slide real fast? Because if you go to the previous slide, take a look at 1980, interest in 81 and 82. You would think with the higher interest rates like that, appreciation would have gone down, but it didn't. It stayed the same or went up. That's the point, right? So as interest, if you can get in, you will be, I don't think higher interest rates are going to be negative appreciation as much, right? So that's the thing. So the average history of mortgage rates is around 7.75% if you take in the account how high interest rates were in 1981, right? And you can see in 2010, the crisis money in 2009, which is after the big recession, then you saw how COVID happened and interest rates really dropped. So when the government stimulates mortgages and the buying of mortgages, you will see interest rates go down. And that's what you saw at the 2009 and in 2020. But if you lop off anything from say 2000, right, you can see interest rates were basically right around 5%. And I think that's kind of eventually where we will settle back down at. Maybe it's 5.5, 5.25, whatever. But I think anything above, the 7% range is going to be higher. I think we're definitely going to be a little bit lower once we get past the whole inflation thing.
Perfect. So I think if we had a crystal ball, Aaron, you're saying we'll be around 5%. Yes, it may be higher now, but don't get too worried about it, because you can refinance the minute the interest rates go down. And at the same time, the time that you are in the market, your house, your equity is growing, your house price is getting appreciated. So, yeah.
Yeah. So, I mean, I guess the other takeaway too is just that, if we wait, so here's where, thank you. This is where interest rates are today, or you can kind of see where we're at. But ultimately, interest rates are based upon the bond market in the United States, the 10-year Treasury. And you can see how this kind of fluctuates on a monthly basis or a daily basis. And this goes from last year. So this is basically from May to May, or April to May, where we're at. And so you can see how in May of last year, the interest rates last year around this time were on 6.5%. And now today we're probably at 7%, 7.125, something like that. And in the October, November area, we were probably at the high peak where we're at. And so the thing is that a lot of people are like, hey, I want to wait until interest rates come down. I want to wait till the 10-year go lower. And the thing is, if you wait, right now, people, if you can qualify for the loan, then now's a good time to do it, because if you wait, if you buy now, there may not be as much competition. You think there's competition now, but if interest rates go to like 6.5%, everybody who missed out from last year from buying and saying now's a great time to buy are going to come out of the woodwork, and you're going to have a lot more people putting offers on homes.
Right.
So right now there only may be 2 or 3 offers. And when the interest rates go to 6.5%, you might have 10 offers on a house. And so the thing is I'm a seller, and I sell my home in, say, October of last year, and interest rates are the highest they've been, and I'm expecting my house to sell in like 2 weeks, and there's no one knocking on my door to buy my house. I'm more willing to give a deal, lower the purchase price, pay closing costs or whatever. But if I waited until January of 2024, you'll see the dip down this past year, then more people are going to be offering on the house, and that same seller doesn't have to offer any incentives or anything else, because there's a lot of more people who want to buy that house and increase that purchase price. So if you can get in before interest rates really dive down, then when you get in, interest rates go down, what happens? We can refinance your loan into a lower rate, save you money that way. But your home value is definitely going to go up because more people can qualify, and there's more demand for houses when interest rates are lower. So if you get in now, equity in your home will definitely go up because the home values will be going up because interest rates have gone down. So just letting you know, not to say buy now, but you better off buying now than you would be if you're later on, for sure.
Perfect. So I think we are also at time, and I think this gives a view of what we expect and where this may go. Any question? We can open out for questions now, if that's okay. I know we had some more things on trends, but I think we've covered most of that.
It's to be 2 hours. Everyone's got busy stuff to do.
Yeah. I mean, there's more on like and we did cover some of this already.
Yeah.
So,
do you want me to do this, or you want to wait?
I mean, maybe we can cover it again briefly. Yeah.
Okay, so go back to the first one, the first slide. So this goes back to the question of points and what is the cost of the loan, right? So what you're asking is, what is the rate today? What you're asking is, what's the cost of the loan with no additional fees? You call that like the par rate. And so I'm just showing you an example. At 4.5%, maybe in this scenario, there was no additional cost. But if you want a rate of, say, 2%, you just have to pay additional fee to get that lower rate. And that's what the points are. Conversely, if you want to go down, if you want to take a higher rate, I can give you money towards your closing costs. So we can play around with it that way to see what's the best break-even point and what fits your needs. But if you go to the next slide, you can see where the zero changes on a daily basis. So this one here in December of 2021, that zero is at 3.25%. In 2022, that zero is at 4.5%. And this is today, but basically today you're probably around that 7.25%, where the zero is. So you can see what the costs of the loan are. So when people ask what rates are, hey, what's the cost of this rate? And because you can still get your 2%, you'll just have to pay a lot more than you had to pay in 2021 to get that 2%.
And that all adds up to the APR then.
Yeah, right? Well, yeah, I mean, that will go into the APR calculation, yes.
Perfect. So yeah, I think this was awesome. This is all we had today. Have we any questions? If you want to come off mute and ask any questions, I think this would be a good time. We did try to answer things that were coming on chat.
Okay. So what was your question? So let's take a look. So any savings tips for me on how a percentage of paychecks should be saved? Yeah, I mean, I guess if you're just trying to save up as much as you can, I mean, again, it's based upon that debt to income ratio, right? So you can't be about, depending on what your loan balance is, where you're at, but typically 50% is kind of where you want to be at. And so if you save up as much as you can, or maybe you don't, you just got to figure out, am I okay with the current payment of, 10% down versus 15 or 20%. The hard part is trying to save up for those down payment amounts gets wiped out as home values go higher or interest rates go higher, right? So I think, again,